Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. Today is May 4th, 2020, and this is the first installment of what we call Charts of the Week. So at BKA, we spend a lot of time analyzing the market. We analyze information, we analyze independent research, and other information that's available in the public domain to come up with our investment theses, as well as our investment allocations and our outlook on the market and the economy. And from time to time, we come across some information that we find particularly interesting or relevant that we would like to share with our clients. That things that we feel like we can distill into a very easily understood format that gives you a little bit of insight on the market around us. Please see our disclaimer for relevant disclosures. In this chart, we plot consumer sentiment and job losses. And if you look on the left-hand scale, this is the consumer sentiment number, and this is an index that's produced by the University of Michigan. On the right-hand scale, it's actually inverted, and this represents the unemployment rate. And so if you can look from left to right as we go from 1985 to really the last month, you can see that there's a fairly strong overlap. And this may be intuitive to most people, but that you're going to have a correlation when unemployment is low, that consumer sentiment is going to be relatively high. And that's the relationship that you see. But in every case, and you see those very distinct gray bars that kind of intersect both in the early 90s, in the early 2000s, as well as 2008, those are recessions. And you can see in every instance that you reached kind of a peak, an interim peak, if you will, in consumer sentiment, as well as the trough, if you will, for unemployment. And so as you transition through those pre-recessionary periods, in 1990, 2000, and then 2000, really 8, I mean, you could see that depicted very clearly in terms of the unemployment rate. And then as you get closer to 2020, as we know that we've just exited this longest period of expansion in post-war history, that unemployment rate was at historic low. And you could see the transition of consumer sentiment consistently got better as we exited that last recession. This is one thing that we've monitored very, very closely, because consumers represent virtually 70% of the U.S. economy. And so they're extreme. What the consumer does is very, very important to the health of the economy, as you can see on the right-hand side, with COVID-19 really taking root and this manufactured shutdown that we've had, that we've talked about often in my webcast, that you can see that not only have we had the very visceral response in the unemployment rate, which just in this last reading spiked to about 4.25, and we know that the unemployment rate is probably going to eclipse maybe even 15%, which would be off this chart. It's very unprecedented, but that dovetails very strongly with the drop and decline in consumer sentiment. So this is a data set that we felt like it would be helpful to show you that relationship, that very strong relationship. And it's something that we intend to monitor very closely as we move further into the second quarter and into the summer. On this particular chart, we have plotted several data points, and I give credit to FS Investments out of Philadelphia for this information. They've done this plot, so they kind of basically looked at the last maybe up to 10 recessions, and what they've done is they made a plot on the horizontal axis. It's the maximum GDP decline, which would be the maximum economic decline for a particular period of time. And on the left-hand scale, the vertical scale, would be the maximum S&P 500 index drawdown. This would be the maximum amount that the index went down from its peak, given the decline in economic performance. So what this data set shows is actually rather interesting. It may seem intuitive that if you have a really strong economic decline, that you're also going to have a very strong stock market decline. And what this tells you, again, with a R squared of 0.19, is that there's really no relationship. That if you have a strong economic decline historically, that you're not necessarily going to have a strong stock market decline. And this goes to the theory that over, maybe the long haul, that you're going to have a reasonably strong correlation of markets and the economy. But over periods of time in which you have an economic drop, that doesn't necessarily mean that you're going to have a bad stock market. And if you kind of translate that to the current day, what we've seen here lately is that we know that we're in the midst of a really strong economic decline, but we've had a stock market that has gone down 34% at its trough, but it's rallied back almost over 20%, if you will, and has really not been as bad as the economic data would tend to suggest. So this is something that for perspective's sake, that we wanted to get out there to show that that it doesn't necessarily, it's not a one-for-one relationship. If you have a bad GDP decline, that you're going to have an awful stock market. And in this chart, this takes that maximum S&P 500 index decline and then chart it against the duration of a recession. So again, looking at the last number of recessions and how long did those recessions last, and then what was the response in the stock market. Now in this particular data set, there is a positive relationship. Now it's not incredibly strong, but it's positive. And what do I mean by that? It just means that historically speaking, the longer that a recession persists, the more the stock market's going to draw down. And so why is that important now? Because we're in the midst of what we know is a recession. I mean, the data is confirming that every single day. But we know that we already had a decline in the first quarter, and we know that we're going to have a decline in the second quarter, which is a technical definition of a recession, 2 consecutive quarters of negative economic growth. But the longer that persists, there's a stronger signal that's being put by this particular data set that the more the stock market's going to go down. So now, having said that, the conventional wisdom as it sits today suggests that we're going to have a really deep recessionary environment for the second quarter, which is the 3 months ended June 30. And then in that third quarter, that we're going to begin to build our way out of it. So we'll have positive performance in the third quarter, positive performance in the fourth quarter, and we will have positive performance in 2021, and eventually, somewhere between 15 and 18 months down the road, we will have an economy that will be the same size as it was before we went into COVID-19. But now, if that assumption is wrong and the recession will last a little bit longer than folks anticipate, or heaven forbid, we have a second wave of COVID-19, which causes another wave of negative economic and stock market performance, earnings performance on the part of S&P 500 index companies, then that could portend weakness in the stock market. So again, while the last chart was really show that there's no relationship between the magnitude of an economic drop in the stock market, this one tends to show a more positive relationship between the duration of the recession and the S&P 500 index drawdown. So these are just a few things that we thought were, at least for this week, were interesting enough to want to pass along to you. We hope that you appreciate us, and indulge us in this opportunity to share some of our insight with you. And as always, we welcome your insight, your comments, your input, and certainly your questions. So please see our contact information there. And we appreciate your interest in watching this particular program today, and we hope you have a wonderful week.